I recently retired in the middle of the largest market downturn in the last decade, and with a stock portfolio that is heavily focused on growth stocks. My entire portfolio is 2 individual stocks and a couple growth and innovation focused ETFs. I don't hold any REITs, I don't hold any bonds, I don't hold CDs. I'm as far from a traditional 70-30 retirement portfolio as you could possibly be. You think I'm crazy, but there is a system to the madness. My name is Daniel, a retired Meta software engineer, and this is my channel, Gainfully Unemployed, where I make videos about personal finance, investing, and financial freedom. If you ask anybody in the FIRE community what a reasonable retirement portfolio looks like, they will tell you something like 70% stocks, 30% bonds, a few years of cash reserves, and a total portfolio that allows for 4% annual drawdown. And to meet those requirements at the bottom of the market, to minimize sequence of return risks. That is the common wisdom. But it's been the common wisdom for the entirety of my lifetime, and I believe there's a more modern way to build a strongly cash-flowing retirement portfolio. One that taps into the potential of aggressive growth-focused portfolios while also reducing the sequence of return risks such portfolios typically have. The secret sauce? Options. So just fire up Robinhood and buy some out-of-the-money weekly call options on Tesla. Okay. Hold your horses. I know, when I just mentioned options, all you bogleheads immediately thought, oh geez, another one of these Wall Street bets degenerates. And while I'm not going to make you buy short-term call options, my strategy does involve selling options on high volatility assets. I, like many millennials, have heavily bet on growth, technological innovation, and the future. While these strategies tend to produce the highest returns over very long time ranges, they are also significantly more exposed to higher volatility and downside risk at any point in time. The general wisdom is that these kinds of portfolios are great for the accumulation phase with a retirement date out decades in the future, but are way too risky when approaching retirement or even during drawdown phase. The statistics of sequence of return risks will simply demolish your portfolio. And this is true if your drawdown strategy is to simply sell a certain percentage of your assets every year. The high volatility of these kinds of assets will amplify sequence of return risks and make them unbearable. So at the core, with a portfolio like this, the problem is volatility. But what if we could turn this weakness into a strength? Phase-in options. If you're unfamiliar with what options are, then you should probably go and learn about them first. This is not an introduction video into options, but here is a quick breakdown. An option is a contract that allows the holder of the contract to buy or sell, depending on the type of option, 100 shares of the underlying from the writer of the option before an agreed upon date, the expiration date, for an agreed upon price, the strike price. The price that the buyer pays to the writer of the option for this contract is called the premium. And the premium that the market typically offers for an option is, among other things, heavily dependent on the underlying equity's volatility. Meaning, options on stocks that go up and down a lot are more expensive. Or more accurately, options on higher volatility growth stocks are going to be paying a higher premium than options on lower implied volatility equities. A crazy high premium, in fact. At the time of writing, 30-day at-the-money call options on Tesla are paying up to 7 to 8% premium of the underlying equity's value. Annualized, that is more than 80% returns just in the premium. By writing call options on even just a small subset of my high volatility positions, I can generate strong cash flow even in a down or sideways market. And I know what you're saying. Aren't you significantly limiting your upside by selling at-the-money call options? And yes, of course, you're right. By selling at-the-money covered calls, I'm in fact completely stifling my underlying upside potential. If the stock goes up after I have sold at-the-money covered call options against it, I will not be making any profit off of that. But we have to consider the premium that was paid for those call options too. And that is, at current prices, still paying me an 80% return, which is insanely good, especially if you consider that the market might otherwise still be going sideways or even down. If you have a large enough position, you can probably get away with writing call options against a subset of your overall position. That way, you can generate cash flow while also still being able to enjoy the potential upside should something unexpected happen. If you would like to capture at least some of the potential upside of the stock, instead of writing at-the-money call options, you could write slightly out-of-the-money call options. That will result in lower premiums and weaker cash flow, but gives you the opportunity to capitalize on some of the potential gains. Writing at the money call options against a smaller percentage of your portfolio, or writing out of the money call options against a larger percentage of your portfolio, allows you to trade off between either horizontally or vertically limit your potential gains. You will want to be careful about applying such a strategy in an upward trending market though. It can still generate strong cash flow, especially with slightly adjusted out of the money call options. But research has also shown that it generally underperforms just holding the underlying in a market like that. Once you get assigned, and you will with a strategy like this, you have one of two options. One, you can just buy back into the position with the proceeds, which is preferable if you expect the stock to continue to go up. Or two, you can sell a covered put for the position. Selling a covered put is interesting if you expect the position to go sideways or maybe even a little down in the short term. Or if you had losses being assigned that you would like to realize while also still buying back into your position. Rebuying back into the position immediately would trigger the wash sale rule and would deny you taking these losses. The IRS will allow you to recognize those losses by selling a put option if that put option is not likely to get assigned. Most tax specialists will tell you that this means that your put option will have to be at the money or even better, out of the money. But please consult with a tax advisor. So, does this all sound a little bit too good to be true? Yeah, and it is. Let me explain. To sell a covered call, you do have to hold the underlying equity. When you are holding an underlying equity, you are exposing yourself to the downside risk of holding it. And if you expect an underlying to go down significantly, you may as well just sell out of the position and invest your money somewhere else. Downside risk is real. And ironically, covered calls will perform best when downside risk becomes realized. If, however, you're going to be holding the underlying equity anyway, selling covered calls against your position can be a way to generate some cash flow and dampen the blow in a downside market. Be aware though, especially as these equities bottom out far from their mean prices, the risk of getting assigned after a sudden bull run or price spike increases significantly. In the end, selling covered calls against high volatility stocks, especially if those stocks are part of your portfolio anyway, is a great way to generate cash flow and reduce your downside risk in those positions. And those are both objectives that you would try to achieve in a traditional retirement portfolio as well. If you would like to follow along and see how the strategy performs for me over the next few months, please make sure to subscribe to my channel and hit the little bell icon so you get notified as soon as I upload a new video. If you found this video entertaining, or if it was useful to you, please leave a like for the YouTube algorithm. If I missed something, or if you have any questions that you would like me to answer, please leave a comment below. Thank you for watching and see you in the next video. I am Daniel and this is my channel, Gainfully Unemployed.